All right, welcome. I'm going to do a foundational lesson about swings, their process, and components, and about mapping markets. In this video, I'm also going to introduce our first course. So we finally built a course. People have been asking for it. And we'll go over the first couple lessons of that course because it has to do with swings, right? The very beginning of the course is learning how to map swings. And so we'll have a look at that. Now, I want to get a few things across, right? Before we trade, we always have to start from the beginning. We always have to structure a market in some way. And if we're going to trade consistently, we need to see consistently. We want to see the market via swings, via waves, without adding our own personal baggage. When I look at a market, I want to see a market via waves. I'm not looking at a market and experiencing or thinking about what the Fed's going to do or what the news is or any of that. When I look at a market, I come in here and I can see I'm structuring this market with some practice. I just see in waves. It takes a lot of the intensity out of the jiggles and wiggles. Right? I'm seeing in minor waves, in major waves. I'm seeing the process of a wave. And it's a different experience of trading to do that. But we need to be able to come to a chart and structure it. This is what market structure is. Structuring this price action, putting form around it. The main thing I want to get across to you here is that the market moves and swings, everything does. And these swing cycles, they have a process that they go through, right? They have to. They have phases. They start and end. They have a process and components that make up that process. It's understanding the process, the components that make up this process. This is what our setups are built on, right? That's first step is mapping. We get some structure. We get oriented to what the market is doing by structuring it. It gives us a reference point. We don't need any outside sources. We don't need anybody to tell us what it's doing. It's going down until it's not. And so this is very objective information. And we build our setup around these pieces, the impulse leg, the shelf, the reaction leg. And then once we have our setups designed, then we add a management to them and turn them into a complete and consistent trading plan. But it all starts with this, with these pieces. And by the end of this video, you'll learn to recognize the pieces. I'm not going to build a setup for you, but you'll learn to recognize these pieces, and then you can make observations yourself about how price interacts with these various components. And you can see how things can be developed. I talk about this in the, designing your own methods blogs and mapping your markets blogs. But you can begin to make observations here. So let's get the foundations down. Let's come over to the course, and I'm going to introduce it, show you how it's laid out. And the first section is about this, and then we'll come back. So from our home page, we have courses, and as you see, right, we're just dealing in swings, just seeing in swings. Now this particular course is a complete method, okay? It's a complete method with learning to build a trading plan around that method. It's a full, complete course, and it's just swings. That's it. Now, the way this is set up, and this particular, right, the setup's just a piece of it. This particular method is a minimum 4-to-1 using swings and components in a certain way. And the way I set this course up is there'll be sections, right? We have 1 through 4 and then 5 here. The very first section here is going to be on market structure. Before we can learn the setup, we have to learn about mapping markets, the swing cycle, mapping them, the swing components. And that's what we're going to talk about today. The next part of the course is the actual setup. It's pretty simple, really. It's just a small part of it. We can't do, in the course, right, when I laid out the course, I can't teach you the setup without teaching you how to identify it. The next part of the course is, once you have the setup understood, this is the most important part. This is knowing how you're going to enter, knowing where you're going to put a stop, knowing how you're going to exit, knowing how you're going to manage it, knowing your position sizing, putting it all together into a trade plan, knowing all of this ahead of time so you can be disciplined and consistent. So this is the planning phase. So you can see how we're laying it out. Learn to map it, learn the setup, learn the planning, and then you start to get the nuances, right? The setup's couched in a certain context, etc. And then the last part is how to review your trades and evaluate them, what to look for, your numbers, and how to practice. So we're going to go over basically these two sections, and how the course is laid out is you'll have a slide with definitions and information, and then a video of me doing the lesson talking about how to map markets, pointing out the definitions. And some of these modules, there'll be a gallery down here that shows, right, this is what we're going to do today. We're going to learn what balance swings are. We're going to learn what minor swings are. Learn how to map all of this. And then in this part, there'll be a section for you to practice and a set of charts with some examples for you to look at, just so you can see it in different ways. So let's go over some of this. So these swings are the common thread that weaves through all markets and time frames. They're the key to understanding who's in control at any given time. Right? They're the foundation of all of our methods. We use them to map, follow, and then trade. So I put all of these definitions over here in this chart for us to work with. And let's talk about them. And let's keep it really simple. All right? Let me just draw it out. There's going to be a process. So for instance, we're going to have a reaction leg. All right? At some point, that reaction leg will slow down and break and turn into an impulse leg. That impulse leg at some point will slow down and then turn into another reaction leg. And this will slow down. And so here we have process. Okay? Got reaction, shelf, impulse, shelf, reaction, shelf, impulse. So somebody asked me about shelves. If we're looking at an upward market, we have impulse. At some point, that must slow down. All things will slow down. They don't go straight up. And, right, it'll just change. You'll notice the angle changes. And it'll act like a minor support level. And then that will crack. And it will have tendencies. And then this is what we'll call the reaction leg. And at some point, it will slow down, crack back up, and turn into the impulse leg. And so what we'll have is an impulse, shelf, reaction, shelf. Now somebody had asked me about these components. I spoke about them in another video. And it's pretty simple, right? They asked about the shelf. And so let me answer the shelf. You can see it in my model here before we go over these. The shelf will have some characteristics, right? It'll slow down, offer support, then often get zoomed, right? It'll slow down, offer resistance. See it, test it, test it, test it, turn. This will slow down, zoom. Now, without getting into fine detail about understanding this shelf, just think of it like this. All right? If all you did on this reaction leg was put the shelf in the upper third, right, capturing the turn, the pivot, you're going to be in the neighborhood. So just do that. On the impulse leg, as it turns out, just put the shelf component in the bottom third, just like I have here. And then later on, you'll learn how to make finer distinctions with zooms and retest. But that's really it, right? There's some nuances to it, but just we're looking at a swing, plain and simple. Okay, you're just looking at a swing. Swing, swing. And just know that your shelf is going to be in the bottom of this reaction. This one's going to be in the top. And so that's the components, and that's the process. And here are the definitions. Frame. Frame is the amount of data. It's like a picture frame. How many bars? What you're mapping will change depending on frame. If I was mapping this, I can still map swings. This is the only swings I'll see. Right? This will be a frame. Or if I was looking at this much data, maybe I'm looking at, but see, I'm still looking and seeing the market in waves. I'm seeing a major, and then I'm seeing a few minors in the major, no matter what my frame. Now, there's no right or wrong answer to frame. It's just an objective definition. I tend not to like too many bars in my frame. I don't want to see too many little itty-bitty jiggles. But that's the definition. A confirmed swing. A new low confirms a new high, and vice versa. And I've done plenty of blogs on this. Now, major is going to be the largest reaction leg. We now know what a reaction leg is. The largest reaction leg in your frame. Okay? Minor will be the next largest. So basically, in practice, as your impulse leg is coming down, here we'll just draw impulse reaction. As your impulse leg is coming down, you'll follow any little swings along the way. As the major reaction leg comes up, you'll follow any little swings along the way. So you can see here we have a big swing locked out, and then we have little swings that also fit a swing definition. Balanced swings, that's same size reaction legs, meaning they're in the neighborhood of being the same size. And what that is, it's showing you some kind of agenda in the volatility that they're hitting it around the same percentage. And it's good information to have in the market, and some of our setups are based on that. And there can be balanced minors and balanced majors. So for instance, these would be balanced majors. And if you see here, these are about the same size reaction legs. And so these would be balanced minors. Now they're not always balanced. It's a distinction that we make. And then I have the definition for impulse leg, right? It's impulsive. It's what's taking out the low. Impulse. Or vice versa, taking out the high. Reaction is the retracement of that. And the last definition is LSB. So we're just going to touch on that. And basically what we're going to look for is in the major reaction leg, okay, there will be swings. And the LSB is what's called the last swing broke. So notice we have some upswings in a major downtrend. And so that would be the last swing broke, and we generally use that for a projection. So in this case, we have a reaction leg. We have a little swing here, look. And then this is the last swing broke. So I'm just giving you some definitions to work with. And it's these pieces that we build our setups out of. Now, just being able to come in and map a market is valuable, right? You know which way it's going. You don't need anybody to tell you. You don't need to listen to the news. You don't need to predict. It's just the facts, Jack. This is always the starting point. No matter what methods you're using, you always start by mapping the market's major swing out. It's always where you begin, and then you layer on from there. This lets you know without a doubt what the market is doing. It's making major swings and minor swings until it's not. And then you'll also know when that changes. You know, in practice, what we'll do is we'll take this major swing and follow the projection on down, and right, eventually it'll start to turn, and we'll gauge whether or not it reaches that, goes past it, or holds. You know, this is what, median lines are based on. See? So in practice, I'm following the market down in real time, and then I'm gauging, I'm using this as a reference point as to whether or not the market is reaching that and holding or bypassing it. And then I'm using that for information. So let's just practice seeing some of the components on different charts. We can take anything here. Here's a gold tick chart from last Friday. You know, if you're here, you just see a bunch of bars and you're jumping around with the ticks, but there's distinctions you can make in mapping it. You know, you can say, okay, a new high confirms a swing low, and basically the market is moving like this, and it will have certain tendencies as it does. There'll be a shelf component here, and you can see price react in different ways. There'll be a shelf component down in here. Even if you can't see it, just put it in the bottom third. Sometimes it's easy to see. Impulse, easy to see. And then look at price. Just make an observation, right? Wide range bar comes back through it, retests, heads down but can't take out the low, comes back through and holds it. So it's these shelves that we'll use for various setups, and you can even see that on a little bitty tick chart. If we're looking at, say, stocks, right, we can see in waves here. We can see and map a market. Here's AMD. Reaction, shelf. Impulse, shelf. Boom, boom, boom. Looks like I got these backwards. There we go. That's the reaction shelf, and that's the impulse shelf. Why? Because it's attached to the reaction leg. And now in real time, right, and then I'll follow even the little swings down, the minor swings. And in real time, I'm watching to see. And it doesn't matter what, learn to see the components, right? This is how markets move. Impulse slows down, makes a shelf. Reaction slows down, makes a shelf. Impulse slows down, makes a shelf. Reaction slows down, makes a shelf. And when you take the bars off, you're just seeing waves, process, and components. Now, that's only the beginning of making a trade. That's just mapping a market. And it can be done on a major scale or a minor scale. You know, we can see once we map, see how quickly, with just a little bit of practice, you can quickly understand that markets tend to move in little swings, and then they grow up to be a big swing. And when you're mapping, you just put structure around it, like this. And that's a lot different than, say, coming to a chart and, you know, trying to figure out what to do based on some indicator. You know, right? There's a reaction leg and there's a reaction leg. Since they're the same, they're both balanced reaction legs. We can then structure and say there's a minor reaction leg and a minor, and they're both balanced. And it doesn't matter what market. Here we'll take the NASDAQ daily. Step 1, pick a frame. It's that easy here. We'll just make it easy with this frame. New low, confirms a high. That's our biggest reaction leg. That's our next projection. This is our minor leg. And it's in the neighborhood, so it's doing minor legs down. That's it. And you can even get a bit curious and look and say, let's go backwards and say, oh, does that match anything? No? Okay, that's about it. So this is how, you know, as we followed it in real time, we had mapped this live as our major swing, and this is how the practice goes, okay? So we had mapped that live as our real swing, our latest major, and then we followed it in real time. Nope. Kind of in the neighborhood, okay. It couldn't beat it. So we know for a fact that once it did that and made a new low, right, still going down, so we're still following it. We're still following it. And by the way, this is how median lines and other tools work. You know, if I was to be measuring this with a median line set, I know what swing I'm trading and what swing I'm measuring. See, that's what a median line set does. And so, you know, before you get fancy with all the tools, you want to understand some simple mapping procedures. And so that's it. Those are the definitions, the components, and, you know, begin practicing and seeing in swings. And no matter what methods or setups you're using, see the setup nested in swings, okay? It will be in swings in some way or another, no matter what you're using. It will be in swings. And so you can begin to couch swings and which way is the market going via major and minor.